Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to break-even point in interest rates. In other words, we're going to start off with a scenario where we have a variable interest rates changing from month to month, as well as the amount that will be financed. We'll figure out the interest related to it for the period covered, and then think about what the break-even interest rate point would be if we had a fixed rate that would result in the same amount of total interest. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 629 break-even point in interest rates tab in the practice problems section. Going to be closing this back out. We'll go through the information up top, then we'll have a smaller component of that information that we can use to work through the practice problem. So the financing needs, this is what we need in terms of our financing for the few months that will be covered, January through June. We got the different or varying financing amounts that we're going to be needing for these months that will be covered. We have the projected annual interest rates for the short-term financing. So we're going to look at the short-term financing and we're going to say, okay, this is what we think the interest rates will be in the future. These are the projected rates. And notice, of course, they are varying rates. So our goal then is to say, okay, where will we stand in terms of the interest charges with our expected short-term financing? And then what would be the break-even point if we were to consider a fixed interest rate that would be equivalent to where we would stand with our expected short-term financing? So I'm going to go on down here. We're going to say, all right, let's have a smaller recap of that information so we can use it to work through the practice problem. We're going to have our little table down here with the interest payments, the yearly rate, the monthly rate, the amount financed, and the interest monthly interest. Now, when you do these problems, note that there will be some rounding that will be involved that we will have to deal with. We did work through this in Excel. I highly recommend working it in Excel so you can practice both the rounding format of it and the formatting of cells with the use of things like interest and decimals and all that kind of stuff. Just standard formatting. It sounds easy, but unless you do it a lot, it can be a little confusing to format the Excel worksheets. So we're going to say then January, we'll have the yearly rate. Now, first thing to note with this table, note when we say 8%, for example, for the month of January, the 8% means a year. That's what interest rate means. When we say interest, it's like the interest of the mortgage. If you say like the mortgage interest rate on your home, the interest rate on your home loan, and you just say, well, it's going to be 8%. Well, that means a year, even though you're going to pay monthly. So that's just the convention. It's the convention for a reason, because note when we break that down to a monthly rate, it'll be much smaller. So there's a couple ways that we can calculate that. Let's then take a look at this. Oftentimes here's the giant calculator. All right, so usually when we do a formula, they often break down the yearly rate to a monthly rate and calculate it in this way. So we could do that. We could say, all right, well, if the yearly rate is 8%, decimal would be 0.08. 0.08 divided by 12 months, because there's 12 months, would be 0.006666. If I move the decimal over, that would be 0.67%. Notice we're really talking about this number, even though they have the 0.67. This is the reason we don't typically use this format, a monthly rate, or one reason, because it's a very small number. It would be hard to, it could be significant for us to be cutting out the decimals with a number that's this small. So in any case, now we could take that number and multiply it times the loan amount, the amount that's going to be financed, the $12,000 at the monthly rate, $12,000, and that's going to give us our $80. Notice it'll be a little bit different that if I round it here, and this is all you can see now, and I was to say, all right, 12,000 times 0.67, 0.0067, moving the decimal 2 places over, that's going to be a little bit different. We get a little bit different number here. Are given that, and so that's going to be the effect of course, rounding. Now, you can also figure this. I often figure calculations like this to say, well, here's the amount of the loan times 8%, 0.08, which would be the yearly rate. This would be the amount of interest if it were for a year. Now I'm going to break it down to a month by dividing that by 12. That's a little bit easier to do when you're just using a calculator than to calculate the monthly rate, because you don't have to deal with that really, that problem of rounding that will be involved. But often when you look at formulas, you will see it broken out into a monthly rate, and you really have to understand kind of both ways you would do that calculation. So then we're going to say the second month in February, we said we estimated it to be 9% interest. So once again, we would say 9%, and we just take that interest rate of 9%, which would be 0.09. We would divide it by 12. That would give us the monthly rate of 0.0075, which if I move the decimal over 2 places would be 0.75. Multiplying that times the loan amount at the end of February, $6,000, that would give us $45, which we can also calculate by taking the $6,000 amount times the 0.09. That would be for a year, 540, dividing that then by 12, giving us once again that 45. Next, we have March. We have the 12%, which is nice because 0.12 divided by 12 gives us exactly 1. So 1% times the 7,000 would give us the 70. And then we have April, which was 15%. So now our short-term rate, we're estimating it to jump up here, which is not good. So 0.15 divided by 12 would give us the 1.25 if I move the decimal 2 places over. Taking that times the 12,000 amount that we think we will need financing for, 150. That could once again be calculated as the 12,000 times the 0.15. That would be the interest for a year divided by 12 would be the 150 there. Then we have May. So May is going to be the 11%. So we take the 0.11 divided by 12. That would give us 0.0091. Notice there's a lot of rounding involved here. If I take that amount, the actual number up here or closer to it, times the 13,000, we're going to get the 11916. If I was to multiply it times the decimal here, 13,000 times the 0.0092, we get something slightly different due to rounding. You can also calculate this by taking the 13,000 times the yearly rate, 0.11. Taking that amount, that would be the interest for a year, dividing it then by 12, gives us, once again, that 119.17. So then we have it once again, last one, same kind of breakout with the 11% divided by the 12. That's going to give us, if I move the decimal over, 0.92 about, multiplying that then times the amount of the loan, 8,000. That's going to give us about 73.33. If I was to use this number, which is not as exact as the one we just looked at, 8,000, because this one's rounded, times 0.0092, then we get something slightly different once again due to rounding. We can also calculate this as 8,000 times 0.11, the yearly rate, giving us the yearly interest, dividing that then by 12 to give us the interest on the month. So then if we added up all the interest, we would get to the 537,500, just simply adding up the outer column. If we add up the amount that's financed over this time period, we get the 58,000. Now, if we want to compare and contrast this to basically maybe what would happen if I had a long-term financing, what would happen if I fixed the interest rate? We might say, well, what kind of interest rate might I be picking here that would be equivalent to this so I can measure whether or not we want a variable rate that takes on more risk, this being the projected amounts that we're thinking could be covered versus a fixed rate that would be standardized. So then we can go down and say, well, we can do a calculation on that. We can say, let's take the short-term financing interest, which was the 538, about 537.50. We rounded it here, so 538. We're going to take the total amount financed, which was the 58,000 over that time period. If we divide those two out, we're going to get the 0.93. There could be rounding involved here because we got the 530, and it's really, let's be more exact here, 537.5. And then divide that by the 58,000. We've got the 0.0092. So again, this is rounded, so about 0.93%. If I move the decimal 2 places over and round the 2 to a 3 here, then that would be the monthly rate. So what we just figured out is the monthly rate. So if I was to then wanting the yearly rate, then I would do the opposite of what we did up top. We'd take that monthly rate, multiply it times 12, then we'd have the yearly rate of the 11.12. So if we look at this pattern of interest rates, we can say, well, what would be the comparable fixed rate? If I could lock this thing down, what would be comparable to the same amount of interest? Well, it would be the 11.12 11.12. If I can lock it down for 11.12, it might be worth it. Now, again, even here, note that we also could take into consider the time value of money, because the fact that we have a lower rate in the first 2 years means we're going to be holding on to the money longer and paying more towards the end of the financing here, which could be beneficial to us, as opposed to a fixed rate where we're going to be paying the same amount at the end of each, not year, but month in the case of a fixed rate. So there's time value of money to consider as well. But then we might want to prove this, so we can prove this by plugging it back into the same kind of table, which would be a lot easier to look at. We'd say, okay, now we're going to take that January number where we're just going to pick the 11.12 right here, the one we just figured. Again, it's rounded, so it's not exact. But then we're going to say because it's going to be, it's rounded. And then we have the monthly rate, which we would divide by 12 once again. So we'll just take that number and divide it by 12. So we're going to take the 11, or let's take the 0.1112 divided by 12. We get about the 0.93. Multiply that times 12,000, and we get about the 111.21. Again, it's rounded, so you have a little bit of rounding involved there. And then you've got February. Again, we're taking the same rate, same monthly rate times the 6,000. That's going to give us the 5560. And then we'll do the same thing, obviously, for March. We got the same rate, but now we're going to multiply it times the 7,000, the month that we need, 6487. Same thing times the ending amount of 12,000. And then May, 13,000. It's going to give us the 12047. And then June at the 80,000 gives us the 7414. If we add this up, then we can prove that at the end of the day, we get to this 537.50, which is the same amount that we got to up here when we filled out the same table. So we kind of proved that this formula here is working. I highly recommend working these in Excel, because this kind of analysis is something that you want to do in Excel so that you can basically adjust possibly this schedule, since this is an estimated schedule of what could happen in the future. If you set up your worksheet, then you can adjust these numbers in your worksheet, which will automatically adjust, your table here, and automatically give you an adjustment to what you can think about in terms of an even or break-even rate for a fixed rate. And so it's really worth practicing setting this stuff up in Excel, because that allows you the flexibility to run scenarios, into the future by just changing a few key components in your analysis in Excel. So these are great tools to work and learn. Excel or Google Sheets, both will work just fine.